Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. Think about this. China accounts for roughly 1/5 of the global GDP. Its manufacturing sector contributes circa 30% to the global industry. China houses 1/5 of the global population and boasts one of the largest middle-income class populations. Also think about this. China has recently made pivotal changes to its policies towards COVID-19 and the property sector. This cannot be a non-event for the global economy. That is why our podcast this week discusses the potential implications of this policy pivot from China. On COVID-19, following the 20 measures rolled out on 11th of November, the government on 7th December unveiled 10 measures to further loosen its COVID policies. These measures aim at easing quarantine and testing requirements, improving vaccination and COVID treatment, and enhancing COVID risk management. The key risk to this reopening is a further rise in COVID-19 cases. Daily new cases reported by NHC have been much higher than in previous months, but they still appear far from potential peak levels. Although case numbers have moderated in recent days, this has been mainly driven by the cancellation of frequent mass testing requirements in an increasing number of cities. Elsewhere, Chinese policymakers have also changed their approach towards the property sector. After putting out a 16-point plan in mid-November to help the troubled property sector, recent days have also seen a policy shift towards supporting the developers themselves as opposed to only piecemeal easing on a project-by-project basis. While this may not mean that the property sector is completely cured of all its ills, the recent policy measures do provide stability and improvement at the margin in the medium term. Now let's consider the economic implications of these two moves. Firstly, reopening is a double-edged sword. In the near term, the reopening process may prove to be bumpy as the nation tackles continued rise in cases and potential strain on health systems. However, over the medium term to long term, this development is a massive tailwind not only to Chinese growth but also the growth of the global economy. In particular, private consumption in China, which has been badly hit during the pandemic, is likely to see a V-shaped recovery. It should be kept in mind that this is likely to happen at a time when the external demand for Chinese exports is fading due to the slowing of the developed market economies. Accordingly, we expect the domestic demand to take over as the key driver of Chinese growth next year. Improving domestic activity should also support the labor market and boost consumer confidence. Stabilization or even improvement in the housing sector should remove headwinds and eventually add tailwinds to Chinese growth. After all, strength in construction activity and boost to upstream and downstream industries such as production of construction materials like steel and cement, as well as furniture and decoration, is a byproduct. The added benefit from a wealth effect could further feed into improved consumption. Now, at a global level, Chinese policy pivot provides tailwinds to growth. At a time when Western economies are slowing, with some potentially even risking a recession, China-led Asian growth is likely to be a strong offset. This plays nicely into our thesis of an asynchronous mid-cycle growth slowdown rather than an outright global recession. Reopening of China may put further upward pressure on inflation domestically, but worth remembering that the starting point of inflation is low. Also, while the rebound in Chinese demand might mean higher prices globally, reopening of China also improves the supply side. We would not be overly worried even if the Chinese reopening is inflationary at the margin, because we believe it is the evolution of the growth inflation mix rather than the inflation itself that is the driver of this cycle. To that extent, we see recent policy actions in China as strongly supportive of improvement in the global growth inflation mix. Turning to financial markets, most Chinese and Hong Kong assets performed strongly since the start of November. For instance, MSCI China Index rose circa 40% in US dollar terms over the past 6 weeks, sizably outperforming the MSCI All Country World Index, which rose 6%. Despite this, forward valuations of Chinese equities remain extremely depressed in relation to those of global equities. Therefore, we expect the recent outperformance to continue as long as Chinese policy remains supportive of reopening and stimulative of growth. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. This is Kishore Muktinutalapati. signing off.